Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Bill Blain, strategist at Mint Partners. Happy Thursday to you, Bill.
Good morning.
Right, let's start off with Bitcoin. It's getting a lot of headlines, obviously in the newspapers and in the press, etc. Above $14,000, up 40% in December so far alone. Crazy world, what is going on?
Okay, let's be sensible about
Yes.
Bitcoin. I think everybody knows that Bitcoin is just the most enormous speculative bubble. We're all sure it's going to break. We are all kicking ourselves that we didn't buy $100 worth 5 years ago when it was launched. You know, that's life. But it's a bubble. We're all aware of that. However, I think we need to think through what the implications of the bubble are. And everyone is always talking about Bitcoin and blockchain together. Everyone says Bitcoin, terrible speculative bubble, and it's very fashionable to say, oh, but the blockchain, it's terribly significant. Well, the fact is they are both part of new finance. Bitcoin itself, I think, is more a product. It's an early iteration of something that the blockchain, this distributed ledger system, has thrown up. And if you actually step back and analyze the nuances of it, you begin to discover that it is a terribly inefficient thing. It takes an awful long time to trade for the transactions to go through because it's the blockchain that runs it isn't big enough effectively, which is why they had trouble about trying to split it. It also costs you far more to transact than you think. We're very aware that most of the business is coming out of China because that's what the Chinese like to do, they're gamblers. But the blockchain itself is going to change finance completely. Imagine a world where you deal direct with everyone without the need for a bank. That doesn't mean that financial services will disappear. It just means they'll change dramatically because, you know what, we'll still have to go and borrow money. We'll still need to have credit ratings to be able to borrow money. So it's just going to be an iteration change within finance, but it will be significant. And this is what people are really looking for when they're thinking about what the implications of this Bitcoin bubble are and the long-term change, the evolution that's coming to finance.
And with regards to trading, you know, the old adage, my word is my bond. You have what used to be T25 settlements, reduce, you know, selling the equities, kind of T2 settlement, 2 days before you pay. Will that disappear? Will it be a case of if I'm a seller, you're the buyer, we do the trade and funds move straight away?
In terms of the way that financial markets transact, we are certainly moving towards faster and faster real-time settlement. We've seen that happen in the bond markets and the equity markets, and that will continue to develop. And eventually, that is only going to be one of the implications of how blockchain develops and industries. At the moment, it's clunky, but in the future, we will make up ways to make blockchain more effective. It's long-term coming. But when we look at the markets today, I think there's lots of other bubble-esque warnings. You know, Bitcoin is the one that's got us all regretfully smiling, but there's other things going on. And one that caught my mind is what's going on in the corporate bond markets just now, where you're suddenly seeing, what's the name of the company, Schneider? The company that owns Poundland.
Oh, no, not a Schneider, sorry. It's a South African company.
Yes.
We will get the name. It's not Steinhoff,
Steinhoff,
sorry, apologies.
Yes. You know, this is what,
sorry,
you know, I spent all day yesterday reading up on them and I've forgotten the name. That just shows you I'm getting old. That's just fascinating how quickly we've seen that collapse in their bond price come.
Yes.
It looks like they could potentially join that very small club of people that have failed to make their first dividend payment on a bond issue. It includes luminaries like Mauritius and things like that, so it's not great. But it's a wake-up call to the bond markets to be really concerned when you get down out of the very high investment grade ratings into lower investment grade ratings, because it still is, or was, investment grade. So another wake-up moment for markets, I feel.
And with the bond markets as well, the likes of these or just below the investment grade bonds, the yields are so low. The risk Well, people have to be aware of the risk. The reward that you're getting with such low yields sometimes doesn't warrant the risk that you're taking that the company could default on its debt.
Let's just look at that in detail, where we have European junk bonds. These are bonds issued by sub-investment grade speculative credits, are yielding less than US Treasuries. That, of course, is because US interest rates are higher than they are in Europe, but not by that much. Because remember, we're talking about the 10-year at 250 in the States, but we're talking about European junk bonds yielding, less than 2%. That just isn't the right reward for risk equation that people should be looking at. They are just too tight, and it's happened because of yield compression being driven by the effects of QE, which has caused investors to look for yield absolutely anywhere they can find it, which has also driven them into other speculative bubbles, and some say the stock market is another. But it's just another example of potentially where the crisis lies. And that crisis is going to get worse, because next year, as we see interest rates normalise all around the planet, corporates are going to find that the interest rate they're paying goes up, which means they start to get constrained in what they can do because they have to repay debt first. What then happens when they all run into the Toys R Us problem? Toys R Us, remember, found itself in the situation earlier this year where they were making profit of 800 million a year, but they had debt service costs of about $1 billion. That's going to happen to a lot more companies as interest rates start to rise. So keep an eye on the bond market. Remember, in the bond market is truth. Equity is just speculation.
Fantastic. On that note, Bill, thanks very much for joining us.
Always a pleasure.